All right, folks, welcome back. This lesson, I'm going to talk about the idea of multiple setups inside of the trading sessions. So there's a morning session and there's a PM session when you're working with the New York index futures. If you look at the market in terms of a split day, the New York lunch hour between noon and 1 o'clock p.m. New York local time, 8:30 in the morning to noon, that's essentially like the morning session. There can be multiple setups inside of that. Now, some of the things I noticed in the comment sections of the videos, some viewers and students are asking, what do I mean by multiple setups? Like, what does it look like? And I kind of want to touch a little bit on that tonight. Also, I want to give you a little bit more perspective on how you can look for additional ways of trading what it is I'm sharing here. If we're looking at the S&P futures mini contract for June 2022, you can see we recently traded up above the relative equal highs. So buy stops and buy side liquidity were resting right above here. So as the market drove above that, we always have the likelihood of seeing it continue going higher. But whenever it goes above relative equal highs and then we get a swing high like this, that being the high here, lower than the higher candle here, and the next candle after this candle, it has a lower high as well. So it's a swing high, not to be confused with a fractal that's used like an MT4. Okay, that is not what I'm talking about. Okay, that takes more candles to make it. And by then, 5 candles later, it's just, you've already missed the move. So you have swing high here. As soon as this candle closes the next day, I'm looking for something to create an opportunity to go short. So we could be anticipating an open here, rally, power 3, which is what I already taught on the YouTube channel. The accumulation, manipulation, distribution, and then incorporating the next level of analysis, which is understanding whether we're going to be in a premium or discount market. Now, obviously, we're in a premium market. We're above old highs here. We really stretched out on the upside. From this high, if we start to go lower, this down close candle is your bullish order block. Okay. The idea of it trading into that down close candle, once it goes above these highs, that's favorable. That's something that could potentially happen. Now, obviously, I have the benefit of hindsight here, but I promise you, if you study what I'm teaching you, you'll see this repeating, okay? So the market does, in fact, trade down into this down close candle. That is your bullish order block, but I want to go inside this particular day here, which is obviously Friday, and we're looking at the internals behind what it is I'm trying to teach you and how you can find multiple setups inside of each respective session, the morning session and the PM session. All right, so here is the hourly chart on the S&P futures mini contract for June 2022. And I kind of want to bring your mindset back into what we're looking for. And that is the power 3. We're looking for an expansion move, direction higher or lower. In this case, we're looking for it to go lower because we have the daily bullish order block level, that line here, level 4504. And look at the lay of the land. Okay, what is it that we see also in the price action? Well, if we go over to the left, you can see we have relative equal lows. We have this low, and we have this low here. So they're relatively equal. Not exactly. That's why I named them relatively equal lows. The idea of liquidity resting below here by itself without the order block is likely, but it's further likely if we have a discount array, which is that bullish order block on the daily chart. So we have multiple factors here leading to the likelihood of this area being probed for the purpose of pairing liquidity, the sell stops basically being raided. Initially in the morning, we were seeing the market trade higher, 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 and then we broke lower, attacking the sell side liquidity here, and then aggressively running into the daily bullish order block. I want you to take a look at this framework from this high down to this low, and this being a fulcrum point, that being if this high trades to this low and we break this low, how far can we go down? I'm going to touch on that in the next slide. But for right now, I want you to think about how the opening price, what's the opening price? Well, there's two. If you're trading index futures, the opening price is midnight at New York time. And that's this candle here. That's the opening price here. And then there's another opening price at 8:30 in the morning. The opening price in the candle that begins 8:30. It doesn't matter what candle you use. I see a lot of questions popping up about that. Like, what's the opening price and what candle do you use? Soon as you have 8:30 beginning a new candle, it could be a 1-minute candle, it could be a 3-minute candle, an hourly candle, 15-minute candle. Whatever that opening price is, that's what you want to note at 8:30. So if you're bearish, ideally you want to see the market trade above that opening price. This is going to be manipulation. Okay? The manipulation is the running above a key level when we are bearish. We're expecting this to go lower. All of this is basically market protraction, where it's a Judas swing. Okay, the market's going in the opposing direction that it's likely to go to later in the day. So later in the day, we expect this to go lower. Where's it going to go? Below this low. If it accelerates below this low, where could it go? Below here. Okay, then we have the bullish order block on the daily chart. So we have a lot of things coming together that draw on a great deal of probabilities. Now, probabilities are not absolute guarantees. Okay, that's not the case in trading. If that was the case, I would never take a losing trade. You would never take a losing trade. We wouldn't need use stop losses, and it'd be great. But unfortunately, we have to contend with risk. That being the case, we have to at least build the idea around the likelihood of a scenario unfolding, but being prepared if it doesn't. So if this market's opening here at midnight and it starts to rally, we can anticipate this selling off. But if it can sell off from here and trade below this low, how much further can it go below these relative equal lows? Obviously, we have the daily bullish order block level here, right here. And let me take you back up real quick. That's this level here, the opening price on this down close candle. That's the order block. Extending that line out in time, you end up with this on the hourly chart. So we drop down into that level, and look at the reaction there. It's nice, isn't it? So going below this low, that's the initial target. Then reaching below the relative equal lows over here, because that's where sell-side liquidity is going to be residing. Then tapping into that bullish order block on the daily chart. But how much further can we go below that level? How far beyond the actual order block level can we go? Well, I'm going to zoom in on a 15-minute time frame. I've already taught this in other lectures, but I want to revisit it here because this is what you're looking for when you're doing your analysis. When everything starts to show a willingness to want to go lower, how do we know it's going to go lower? Well, we have the swing low here, decisively broken. See that? This low, broken hard. Then we trade back up into the imbalance here, so the fair value gap, we trade up into it here. At this point, we anticipate the candles past this, or the new forming candles, to trade lower and trade below this low. And if it does go below this low, we're looking at this price point here, that low, as a fulcrum point. That being measuring this high down to that low, that same measurement of distance, and we expect that projected lower. Okay, so this is my swing trading model, and I'm applying it to targeting. So the way you do it is you take your Fibonacci and you anchor it to the highest body. It could be an open or a close, it doesn't make a difference, but you anchor it on that. Notice I'm not putting it on the high here, and I'm doing the same thing with the lowest open or close in this swing low. This retracement up, I'm measuring the distance in terms of range with the bodies of the candles. The first time I taught this on YouTube, I had a lot of folks scratching their head and many trolls saying, he doesn't even know how to use a fib. I'm showing you how the algorithm is going to read the price. Okay, the wicks and the tails are all distractions. That's all going to be largely attributed to what especially if you're trading with Forex, and obviously I am aware that this is not Forex, but I learned this through the models that I employ with Forex. Now, it's a carryover in terms of analysis because you can apply it here as well. It wasn't always like this. When there was open outcry only and there was no electronic trading, this wasn't as pure as you're going to see and as it's been shown in the past by me in other videos and examples. But by having a measurement from the highest body in this swing up, in this swing low, the lowest body, that means the lowest open or closed, okay? I'm anchoring the fib on that. The settings on the Fibonacci I've included here, and these are the ones that's highlighted for this illustration. So below this low, we're looking for it to run into sell side. So if it goes below this low and aggressively expands lower, this could be your next target, 45.14.5. If it goes below this one, we can anticipate it trading down to what? 45.01.25. Now, the question you're going to probably have in your mind is okay, this is all fine and great, but how do we know which one to pick ICT? If you put 1,000 lines on your chart ICT, eventually somebody's going to see one of those levels get hit, and then you're going to make a video and say, see how smart I am? I've seen all of your arguments. I've seen that kind of stuff tossed around in the forums and such. So if we look at the idea that 45.04.25 is just below what level? That daily bullish order block at 45.04. Well, at 45.04, and we're getting a measurement down here, that means we could see it trade down to that level here. Now, if you look up here at this level right there, that low is exactly the candle's low right there. Don't take my word for it. Go over to TradingView, pull up the June contract for 2022, E-mini S&P. That is your daily low. You can't predict daily highs and lows, ICT. That's impossible. Well, it is possible if you understand the elements that these algorithms operate under. And my question to you is, can you get any better than that? Is there any other measurement in terms of precision that gets you any closer to 45.01.25? Not when the low is 45.01.25. Look at the reaction there. Now, the order block level is just right here, but it stabs down into what the algorithm is going to measure. So there's the order block. It wants to go down to it anyway. There's relative equal lows. It knows there's liquidity down there. And you have the measurement. So the precision element is only going to be beneficial if you have all the other narrative incorporated with your analysis, that being the market's likely to go lower because we ran out those relative equal highs on the daily chart. We created this swing high. We broke lower aggressively. We're likely to trade into that daily bullish order block. Then we have this retracement here. It completely closes in all the imbalance that's between this low and this high of that candle. It rebalanced all that, and then we roll over it. Here's that gap I mentioned. Trades up into that. We anticipate what? The candles after this candle closes. We want to see acceleration to the downside. We get it. The market starts working lower, lower, and finally, right on a dime, that candle is that low, and that's your swing projection I teach in this YouTube channel. You will not get that measurement if you use this swing high and that swing low. That's why everybody that uses Fibonacci struggles. Oh, Fibonacci's a joke. It's not a joke if you are doing the measurements correctly. Now, these are just targets, but they are more meaningful when you apply and layer other things in analysis, like the purpose of running to liquidity below those relative equal lows into a discount array, which is the bullish daily order block. When you bring that together, you get these types of results, which is perfection. There's nothing better than this, folks. You cannot improve upon perfect. All right, so taking this a little bit further, now we're into a 15-minute time frame. The opening price, again, is this candle here, which is midnight, New York time. The opening price, that candle, you extend that out in time. If you're bearish and you are looking at your daily chart, because the majority of your analysis should be framed on your daily chart, where is it likely to go? Where's the expansion likely to take price, higher or lower? That's the main thing you're trying to look for, because that's going to carve out your bias. So if you know that the likelihood of price wanting to draw down to this daily bullish order block, and we have that level of 45.01 and a quarter, which is that candle's low, we don't need to have that yet. But we know that this is going to be a draw on liquidity because it's also below those relative equal lows that I mentioned when we were looking at the higher time frame chart. So all of this here is a buildup into a premium. The market then breaks aggressively. What did it create here? What happened here? We had a displacement down. Did that take out that swing low? Yes. Does it trade up into that imbalance right here? Yes. Does it trade above the opening price? Yes. How many boxes did we just check off there? A whole lot. Probabilities are now going through the roof that this is bearish. Then the market breaks lower, trades down to the old swing low, sell side liquidity resting below there. Watch what happens. We trade down through it, and then we aggressively rebalance all of this down move. We come right back up into it, bearish order block, then sells off another wave into this short-term low, deeper below this low, and into, eventually, into the lunch hour and past it for the daily bullish order block. Now, when you look at this type of price action, you might not see that as an entry, but it is taught to you in this mentorship on YouTube. That is the lesson right here. Because if you look back here, we have these highs. We trade above it. Does it break below? It does. Does it give them a balance? Yes. Does it trade up in here on the 9:30 opening? Yes. And then does it run where we want it to? Liquidity and discount array in the form of a bullish order block? Yes. But what other setups are here? Because I mentioned in my Real Money, Real Results series where I was showing actual live account results and proving that these things make money, not just in demo. And by the way, I appreciate all the feedback I'm getting in the commentary section of each video, the comment section. But I've read a lot of the questions about, what do I mean by having no more than 4 trades? 2 trades in the morning, 2 trades in the afternoon. What did I mean by that? Because I read one guy, he was saying, I can't even find, 4 examples of this. Or I may not be saying this correctly, but he can't find that many examples of it forming over the course of a week, let alone a few times in intraday. So we're going to walk through today's price action and show it with clarity. All right, so here's the opening price again on a 5-minute chart. Here's the 15-minute time frame fair value gap. And the market trades right back up into it above the opening price. That's what it would look like on a 5-minute chart. Notice it does not look clean like it does on the 15-minute time frame. Let's go back up one more time. See the gap here? And that run right there at 9:30? That, coupled with this time frame, you probably wouldn't see that as a sell. You would want to see this filled in. But you got to look at the higher time frame. The higher time frame, 15-minute time frame, is providing you the framework. It's giving you context that, okay, this is all we need. We don't need it to trade up into that. It could, but we don't need it to. So when it trades up there, then it starts to break down, it rebalances, breaks down again, works into that short-term low, sells off again, retracement, sells off again. In here, this is your entry at the opening. So in the morning session, you typically have 2 to 3 setups because you have volatility coming in at the opening being 9:30, New York local time. That can be very tricky. If you're not really sure what you're doing, you can get caught up in the initial volatility and offside real quick, and it can run against you aggressively and hurt you. I prefer to see my students look for the initial move to kind of like qualify what you're expected. Lower prices, right? So does it give it here? Yes, it does. So how can you participate in something like that and still have the bias behind you and have multiple setups that you can take? Well, let's take a closer look on the lower time frame. Here's the 1-minute chart. Here's that return back up into the fair value gap on the 15-minute time frame, and wasn't so clear with the 5-minute. But now look what we have here. Small little imbalance there, that fair value gap right above a short-term high. We trade up into that there on a 1-minute chart. You would see that as a setup for the 1-minute chart. Before I go any further, I want you to pause the video. I know some of you don't like to do this because you just want to get through it. You're watching the video at 2 times the speed because I talk slow. This is a time when you want to stop. Slow down because you will cheat yourself out of learning. This is the little moments, like when I'm teaching my private group, these are these opportunities. If you waste them, you do not learn the best way. Okay, there's a good way of learning, and there's the best way of learning. And the best way is actually participating, not just casually watching. Don't Netflix binge watch ICT. This is where you stop the video, ask your spouse or whatever to give you a couple minutes to focus, undisturbed. That way you can pull out the things I'm trying to show you in this lesson. Otherwise, it's just another, event where I'm talking about hindsight. But what I'm showing you here is something that repeats every single day. This is how I can go in every single day and take money out of the marketplace. I took the live account up another $1,000 today, so we're over $51,000. And these are the types of setups that you can do. You can find these, and you don't have to have the absolute perfect entry at the opening. You don't need that. Okay, that's the benefit of what I'm sharing here publicly. I want you all to have the ability to feed yourself and your own family, not to rely on a job. If you look for these types of setups with this logic, I am confident that you can do what I just said. And those that really want to supercharge it can take it way beyond that. Competitions, whatever. But we have the logic here. That's that old short-term low. All I did was extend the line out because it doesn't exist in the chart over here because I don't have enough of the data showing. But that short-term low, that was a fulcrum point, remember? That's this low here. So I'm referencing that, showing that there's where the sell side liquidity is. But I want you to pause the video and go through this price action and find the setups that you would see as a shorting opportunity if your bias was in line with what I'm suggesting here, as it should have been, being bearish. Okay, I'm going to continue the conversation. If you are not ready, you've missed your opportunity. All right, so the first fair value gap here, right there, because we have this short-term low broken with the run lower. So there's displacement there, obvious displacement, very energetic. And we have this candle's high, this candle's low, and the market returns back up into it. You can go short there and look for what's the first objective, that fulcrum point, that short-term low. Aim for the liquidity, so your target would be there. So you could do, like, say you did 2 contracts, entry here, short here too. You can take one off here, let it ride, and then see if you can get that lower time frame objective later in the day. Now, I don't want to take entries during the lunch hour between noon and 1 o'clock, but you can take profits if you're doing like a partial, like if you did one here. If you did 2 short contracts here, you took one off at your first target, and you want to see if you can get the other objective. If you have a limit order at the order block level, plus a couple points, it could fill during the lunch hour. You don't need to be babysitting it and being in front of it then, because you've already funded your position and trade by taking one off here off and moving your stop to break even, and just see what it can yield in terms of the daily range. Next one is here. Another short-term low taken. Fair value gap there. We trade back up into it. That's a short. You can go short here. And again, same premise, looking for the first run below here. That'll be your target. Taken there. If you did multiple contracts, you would get short here. Say 2, take 1 off. This might scare you. Not so much probably if you were short from up here, but here could be a little bit intimidating. But if you've taken one of the contracts off below here, even if it were to come back up and take you out and stop you out, the first contract allowed you to be profitable. So it kind of balances things out. Another one is here. We have the imbalance here after we aggressively moved lower and then retraced back up in. This is why I'm saying that that previous short, if I was short from here, I wouldn't be worried about this one so much because your stop would be above here. Now, it got close to it, but I've been many trades over the years where it moved within a quarter of a point without stopping me out. And it's a scary feeling, especially if you have a lot of size behind your positions at the time you're in the trade. But it's still a little intimidating because if you completely fulfill your model and follow it and all the rules, and you don't want to move your stop and you just allow the stop to be taken, there's been many instances in my own trading where within a quarter of a point, it doesn't stop me out. It's not like Forex. These markets are a little bit more professional in the sense that they're much more precise and uniform in the delivery. You don't get these wild, erratic little spikes and spreading, of the price action, because everybody's working with the same price here. Versus in Forex, you're trading within a pool of liquidity within your broker's in-house. And they have a little bit of luxury there where they can open that spread on you. And that's why it's a little bit trickier to operate in that versus something like this market here. It doesn't mean I don't love Forex still. I do. But right now, Forex is just quiet. It's not doing things that I would promote in my students' attention. I'm telling all my students, both in my private group and you all here, that this is the markets that you should be following. These markets right here, the index futures. I'm sure there'll be a time when we transition from index futures back to Forex, but until I see them loosen up a little bit in the currencies, my attention is here. Okay, so anyway, getting short here. This was a shallow run below that old low, so we anticipate it to run a little bit deeper, and it does. Okay, so you could take profits below this low here as a partial, and then you've seen now obviously multiple opportunities within the same morning session. So it's also showing you how, if you miss your entry, how can you get back in line with the marketplace and still participate in these moves. Now, there are going to be days where we don't have this many retracements back and back and back and then goes lower. It'll be just one or two and it just keeps on going. Or many times it'll be just right at the opening and that's it. You missed it. It just goes right to where you thought it was going to go for the day. And you can't get mad about that. You should be happy that your analysis concepts are speaking to you with that much clarity. And just know that because they repeat, none of you should be upset that you missed a trade. Like none of you. Nobody has the permission, okay? You have no right to be angry about missing a trade because they are like buses, okay? Mass transit buses that come by like a schedule. Every certain time of the hour or day, these buses are going to come around. These trades are just like that. You can set your clock to them, okay? They're going to form. They're going to be there. Your number one goal is to understand where is it likely to go to? Where is it likely to reach for? And if you have that understood, it becomes so easy to know what you're looking for. Notice what I said there? It becomes easy to know what you are looking for. I did not say it's so easy for you to make money. There's a strong contrast there, okay? But by default, over time, once you have been doing the things that lead to you understanding what it is you're looking for, and that part becomes easier, what do you think the default result was going to be from that? It's probably going to be easier for you to make money over time. Okay? So I'm keeping things in balance so that we understand what I'm saying without sugarcoating it and making it sound like anybody can walk in here and do this. It's going to take some effort. Now you're probably looking at that pink rectangle asking yourself, what the heck is that? Well, that is the PM session buy side liquidity pool. What does that mean? This high here was the most energetic one in the morning session. It took us all the way down to what target we were looking for, the daily bullish order block. Because it's Friday, because it hit the daily time frame objective, it's in a discount market. It's really traded lower. End of week, there's going to be a retracement back into the weekly range. What can it aim for? Well, it can aim for the liquidity resting right here, because a lot of people are going to say, wow, this is the place where my stop should be at because I want to hold on to this thing over the weekend. Now, I don't know who has the courage to do that anymore with all the things going on around the world. I personally don't have the courage to hold over the weekend. It's just too many things can go wrong. I'm not sitting in a potential opportunity where it's 1,000-point gap against me. When we start trading on Sunday. No, thank you. I'll pass on that. But this area here is where you would anticipate on Fridays where liquidity could be a draw because it's going to likely pull back up into a premium. What does that mean? Here's 8:30. Here's the turning point at the 9:30 rotation. So this high or we could use this high here. It doesn't make a difference, but I'm going to use this one because we're framing the logic behind this day being bearish. So this high down to our target, if you put a Fibonacci on this low to high and find the 50% level, this is above 50%. So that means above here, that's a premium. So the market's going to move from what? A discount to a premium. That's what the market does. That's the algorithm does. It seeks discount to premium, premium to discount. Within that logic, the market is reaching for liquidity in the form of buy stops and sell stops, and or imbalances, or the creation of an imbalance, fair value gaps, or returning back to a fair value gap. Okay, that's all these algorithms do, and they do it on the basis of time, then price. Now, that's a gross oversimplification by me, but by far and large, that's all these things do. It's not your buying and selling pressure, okay? It's not the effects of the DOM, okay? I got a lot of people asking me because they watched me show things in my live account, and they think I trade with the DOM. I don't trade with the DOM, okay? I'm not looking at the DOM, trying to read how many orders are resting above or below, because there's spoofing that goes on. And those orders may not be there when the price goes there. So I don't think that the DOM is something that is useful. I'm only throwing that in here because I saw a lot of people in the comments asking about those types of things. And I don't use them. I don't use them in my trading. And I don't think there's anything in terms of advantage in using it. If you believe you're being profitable because you are, don't let my comment change your mind. And I'm not trying to open up a dialogue for debate because you're never going to convince me. Okay, so you're okay if you're using it, but I'm answering students or viewers, and that's my opinion. Okay, so I'm not trying to begin a debate about it. Okay, so we have a PM session buy side liquidity pool that the market could likely reach up into, and again, the logic is we moved from this high down to a target. It's Friday. There's probably going to be position squaring. They're going to want to take the market back higher. So what are they going to reach for as an opposing move? Notice what I'm saying here. This was the target. There's going to be short covering. Who's short covering? The smart money that sold short here, 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 and here. So if they're covering a short, are they bearish still? No. So if they're not bearish, what are they? Bullish. So if they're going to be smart money and buy down here, or if they're going to use this imbalance in here, if it trades down into that, you can see a run higher. If they're going to buy it, what are they going to target? The buy stops up here. And they're going to sell right to those buy stops. They're buying this and selling it to these waiting buyers on their buy stops. Notice these relative equal lows. They take it into the order block right below those relative equal lows. Because it sells what? It sells the retail crowd that this was support broken. What are they going to want to do? When it trades back up into these relative equal lows, they're going to do what? Sell, right? That creates more liquidity for buying. So this is engineering buy-side liquidity on the basis of sell-side flow. Sellers coming in the marketplace. These sellers, they're going to have a counterparty in the form of smart money buying it. They want to sell short because they see relative equal lows breaking. The trend's been down. Everything looks bearish to them because it's been going down all day long. So they think naturally it's going to keep going down when it's only traded down to where the algorithm says this is what we wanted. And now we're going to reprice higher. We're going to move from a discount to a premium. The premium intraday is going to be this area here. And that's going to be where the market draws to for the afternoon session buy side liquidity. All right, I was going to do the pause the video type thing here, but this is going to be a long video, so I'm just going to go right into it. All right, so we have a mitigation block here, and I teach that in the YouTube channel. But we have market structure breaking. We come back down into the mitigation block, and we also have the imbalance, fair value gap there. So we can be a buyer here. And remember, the 45.32 to 45.40 level. Go back up to this chart here. Right in here. So this high, right here to here. Think about those price ranges. We trade up into it here. So buying here and aiming for that liquidity up here, that would be your target from buying to getting out there, selling to those waiting buy stops. The next one is here. The market trades down in, and I count you to go into your chart. I left this out for your own personal study, but if you look to the left, go over here, you'll see an old high. Okay, old highs are a discount array. If we trade above an old high, that old high becomes a discount array. This is where, not all the time, but this is where old highs being broken become support. That's why sometimes the books have it right. That's why sometimes your analysis will be right about specific key highs and lows. But notice they're not always consistent, and that's the problem. So you want to know what makes a old high or an old low real support or resistance when you have the logic what I'm framing here, because we know that the likelihood that the market's going to draw up into this area here, because that's where the buy stops are resting above the marketplace when it hit the order block down here. So what we're saying is the market's going to bounce from here up into this vicinity here. So if the market comes back down in and touches, it could have touched this high here, but there's an old high to the left over here. You'll see it. It trades down and hits that, and it also fills in an imbalance. When you have that, old highs broken will act as support. So there's something for your notes. Then we have the run up into that area. So it's not a bad little run. Now, once we get up into that shaded pink area, what have we done? We fulfilled buy side liquidity in this area here, but we have a little bit more later on, which obviously you can see it runs to. But here we see it do a run lower. So we break below a swing low. Market structure shifts. Is there any imbalances in here? No, but there is one right there. See that? Here's your fair value gap. Shift in market structure there. Retraces back up into the fair value gap. You can be a seller there and aim for this low or the order block. Or you can wait for a confirmation entry, which is we turn here after it hits that fair value gap, breaks lower, and then we have another break in the structure of the marketplace on the 1 minute chart. Creates the imbalance here, fair value gap, trades up. Yes, it overshoots it, but we also have two fair value gaps. Remember the rules I gave you? If you have a fair value gap and a smaller one right above it, anticipate it likely trading up into you, but use this as your entry. Go short here, and then aim for the order block. So, if you have an understanding of how we're going to work within the intraday volatility, using liquidity, using the time of day, using the day of week, all these things come together and they make a really beautiful tapestry so you can read price action. Now, I know there's a large number of you that are going to watch this and it's going to feel and seem like obviously anybody can go back in time and do these types of things. But a lot of my trades, when you see my examples and you see the things I record and show you, they're using logic like this. So it's not contrived, it's not form-fitted, it's not cherry-picked for the purpose of just being something to talk about. This is what you're looking for. And when you do your back testing, I got a lot of questions in the comment section about this as well. You go through your charts, just like I'm doing here, and you annotate them. Now, in all these areas where there's empty space here or over here or over here, you're putting in little notations and you're typing them out. And yes, it takes time. Yes, it's tedious. Yes, it takes a great deal of effort and desire. But this stuff rewards that. Like it rewards it. It's not like fantasy football where, who cares if your team wins? This pays you. This is something that you can feed your family with. Okay. If you need your expenses to be reduced and you don't want to get another job, or you take a pay cut, maybe you had a job loss or whatever, this skill set can fortify any weak links in your financial chain. Okay, you want to build strength in your ability to make income and build legacy wealth. It's worthwhile for you to spend time learning this. And that means going back through old charts and old moves and literally going in and annotating the moves like this and mapping them out and seeing the logic that's there. Now, do not be afraid that you're going to do it wrong. All of you are going to be doing it wrong in the beginning. This is a skill set in backtesting you're trying to discover. Okay? You're not trying to do things correctly in backtesting. Backtesting is you in a mode of discovery that proves efficacy. If you can't see things repeating, then you got to go back into the core content lessons of this YouTube channel and ferret out what it is I'm teaching conceptually. Then once you understand better what it is I'm showing you, then you go back into the old data and look for those very things occurring. Then highlight the things in your chart that makes the most sense to you. Over time doing it, and frankly, you should be doing this at least a minimum of a year. Okay? Make it a practice of doing it all the time. Even when you start trading with live funds, your trade journal should always have annotations. You should always have charts saved and just constantly referring to what you witnessed in price and record it like you saw it happening and knew it was going to happen in advance. That's called self-talk. Okay? You're literally tricking your brain into seeing your annotations as something that you foreseen coming. And that way, when you go back and you read your journal and you study it on the weekends or whenever you go through a period of drawdown and you need encouragement, you go back to your charts in your journal and you'll see annotations that you wrote out yourself, and it tricks your brain into believing that you've seen that all along. Now, what happens by doing that over time is you have created creases in your brain where that knowledge and that pseudo experience has been retained. But your brain remembers it as what? A real experience that you endured. But you're recording it with positive reinforcement in your commentary. Never put negative comments in your annotations. Don't say like, oh, I was stupid, I missed this. Oh, I'm so dumb, I fell victim to the shark pattern. Don't do all that kind of stuff. You don't have to worry about swimming with sharks. You don't have to worry about animal patterns. You don't have to be worried about any of those types of things. All you're looking for is liquidity, imbalances, time of day. That's it. That's it. That's all this game is all about. Okay? The algorithm is not going to try to follow some retail logic stuff. It's based on where's the money? Where's the money? Who's the most easy prey right now? And where is the majority of the money? And that's where it's going to run for. That's all it's going to do. And if you strip everything you think you know about the markets away and just give me a couple months, stay with me for a couple months here, and I promise you, you will put everything else down and see it like this. Because this is the truth. This is the perfect understanding of what makes these markets book. That means what makes them go up and down, where they turn, why they go where they go, why are they moving when they move, and why are they arriving when they arriving at that price point. That's all algorithmic. And it has absolutely nothing to do with ratios. It has nothing to do with anything harmonic, nothing supply and demand zone, nothing to do with Elliott wave, nothing to do with Wyckoff, nothing to do with Gann. None of that stuff has anything to do with it. I literally have just explained exactly what these markets do. That's it. There's nothing else that happens. The buying and selling pressure, it's a myth. Because these markets are going to go higher regardless of how many contracts come in. If they want this thing to go up here, it doesn't require millions of contracts to put it there. It doesn't. How many contracts does it take for this candle to move from that opening price to that closing price? Tell me, how many contracts does it take for that to happen? It only needs two transactions. Two transactions, one here, and when it gaps up here and reprices to that price point and it offers it to the market that price and someone comes in with a market order, what happens? Boom. It's it. The candles have been created. Two trades. How many contracts? It doesn't make a difference. You only need a transaction. What? Yeah. Folks, listen. You can sit down and listen to these videos I'm producing and come in with the preconceived notion that everything I'm saying is nonsense, it's not true, and it's not valid because you don't want it to be. All I'm asking you to do is put everything you think you understand, put it aside for a moment, just for a little while, and go in and do the things I'm telling you to do. I guarantee you, you will absolutely fall in love with this, because this is consistency. This is consistency that you have always hoped for, but everything else just falls short in delivering it. And you're getting it for free. And I'm loving it while giving it to you. Because I know, and you're all going to see it, when all these little light bulbs come on, and all of the people watching these videos, and folks, this channel's growing. It's growing. And this train's going to keep on rolling. Yeah. This community is getting bigger and bigger because it's infectious. Results matter. Proof matters. And when students go into this and they see the results, man, it's sweet, isn't it? Isn't it sweet when you see the truth finally just laid out in front of you? There's no trickery here. There's no twisting of your arm. Give me your credit card payment. You don't have to blow any kisses to me. Okay. I don't need flowers. I just want you to make a real effort and then tell me what your results are. What did you get from it? I promise you, I'm promising you, you will find what you're looking for, but you got to put the work into it. Because if you don't put the work into it, it won't matter. Because you'll just think it's too much work. And I'm telling you, it only feels like a lot of work in the beginning. But once you understand what you're looking for, like this setup here, that might be your particular setup. And this up here isn't your setup. This might be your setup here because it's based on that old high that you'll find if you scroll back on your own chart. That might be your setup and not this one down here. That's what I'm referring to when I say when you find your unique model. That means a setup that is so similar every time you take it, it repeats the same general idea just in a different chart on a different day in a different time frame. It's it. That's all it is. That's your unique model. You're learning how to do it with what I'm teaching you, but where you're looking for it, in what market, in what narrative that you're looking for, what makes that setup your particular setup, that's a unique thing for you. And that's the weird, beautiful element to trading and the way these markets operate is it allows each and every one of us to have our own unique model. We can all use the things I'm teaching and all find setups within the same trading day and be opposed to every individual trade setup individually. In other words, we could all be doing something and not agree with any of it. You took a short there, I was long a little while before that, or I went short and you went long somewhere else, and you're ending a trade where I'm getting ready to put on a trade. It's amazing. But how you internalize the market, what setup you're looking for, there's lots of them. And if you break this chart down into a 30-second chart or a 15-second chart, there's even more setups. Everything's fractal. So if you want to do high frequency trading, you can do that with the second chart. You may not be able to pull up second charts because you may not have the, the subscription level on TradingView. And I don't get any subscription kickbacks. I'm not trying to get you to buy anything from TradingView. I'm just stating that you can make this however you want. And if you just want to stay on a 15-minute chart and trade the daily range, okay, there's no reason to do anything less than that. But if you want to get busy and pyramid your positions, that means like say you bought one down here, or say you bought 5 down here, and you bought 3 here, and you bought 2 here, and then you rolled it up into your objective. That's pyramiding. Your biggest position put on first, then a smaller position on, and then a smaller position on. And then that's how you build up the equity and you get velocity in your equity growth that way. Versus buying 1, then buying 2, then buying 4, then buying 8. That is reckless, and I've done that, and I've roasted accounts doing it. So don't do that. But hopefully this has at least got your gears turning about how you can go in and back test a little bit, how you can see multiple trade setups, and how we can work with higher time frame PD arrays and the PD array matrix where it's discount the premium and premium to discount and how we use and incorporate all the different arrays, where I'm sure someone new watching this, your head's spinning right now. You're like, I have 1,000 questions right now and I need to know this. No, you don't need to know what you're asking for right now. You only feel like you need to know right now. Take the things I'm showing you at the pace I'm showing you, study them. And I promise, a couple months from now, you're going to know a whole lot more than you know right now. And you'll be able to go in and see things in price action that you don't even identify right now, even in hindsight. You just got to give yourself the time and give yourself the real effort to learn this. I've stripped it down. I made it as streamlined as I possibly could. And I promise you will get this. And until I talk to you next time, be safe.